Hello everyone. Today we are looking at the current state of Japan's hotel market. As the title suggests, we are at a critical turning point. The era of simply betting on general market growth is over. We are shifting from a phase of quantitative expansion to one of quantitative selection. Let's dive into what this means for your investment strategy. First, let's look at the headline numbers. On the surface, the market appears incredibly robust. Inbound tourism continues to be the power engine of this sector, with foreign guest nights reaching 60.48 million, a solid 3.7% increase year over year. This success story is dominating the headlines and driving a lot of general optimism. However, if we stop at the headlines, we miss the real story. Beneath that surface growth, there are deep fractures forming. To succeed in this next phase, we need to understand three fundamental structure shifts: the decoupling of the demand, an operational paradox regarding occupancy, and a significant geographic spillover. Let's break these three down. The first shift is the great demand decoupling. The post-COVID revenge travel boom for domestic Japanese travelers has ended. Inflation and stagnant wages have cooled local demand, causing a 3.6% drop in domestic guest numbers. The market is now entirely propped up by the 3.7% growth in inbound guests. This means assets relying heavily on domestic customers, like local business hotels, are facing significantly higher risks. The second shift is a paradox. Total guest numbers are actually down by 1.60%. Yet room occupancy rates have risen by 2.5 points. Why? The answer is a severe labor shortage. Many facilities physically cannot clean rooms or staff front desks, forcing them to limit sales, a practice called Uri-dome. This supply constraint is artificially inflating occupancy and pricing, masking the underlying labor crisis. This labor crisis creates a clear divide between winners and losers. The data shows that tech-enabled, efficient assets like business hotels are maintaining high occupancy at over 80%. Meanwhile, labor-intensive traditional ryokans are struggling at just 42%. In this environment, operational efficiency isn't just a bonus, it is a survival requirement. The third shift is a geographic. The prime metropolitan area, Tokyo, Osaka, and Aichi, are effectively full. You can see that inbound growth in these major cities has actually stalled or slightly decreased due to capacity limits and high prices. Instead, demand is spilling over into secondary regions, which are seeing double-digit growth. The opportunity is moving from the center to periphery. Finally, we face a hardware problem, an asset mismatch. Japan's existing stock consists largely of small rooms designated for domestic salarymen staying one night. However, new growth is coming from Western tourists who stay longer and demand more space and comfort. We have a gap between what the market offers and what the new customer wants. So given these shifts, simply betting on tourism in Japan is gambling. Future returns must be engineered through a disciplined focus on three strategic pillars: operational capability, location selection, and asset adaptation. Pillar 1 needs to win with Efficiency. In a labor-constrained market, the most resilient assets are those that use technology to lower their break-even point. We are looking for automated check-ins, cleaning robotics, and dynamic pricing software. This is the only way to secure high and stable margins when staff is scarce. Pillar 2 is to win with location. With entry barriers in Tokyo and Osaka at all-time highs, the next wave of growth is in the spillover markets. We are targeting secondary cities like Kanagawa and Aichi, as well as high-value resort areas that can absorb the overflow from the metropolises. Pillar 3 is to win with adaptation. Investors must move beyond simple acquisition. The value lies in transformation, converting outdated domestic stock into assets that fit inbound needs. This means renovating 2 small rooms into 1 premium suite, or converting standard hotels into apartment hotels for long-term stays. To summarize, the market is clearly dividing. Winning assets are efficient, located in spillover zones, and adapted for long stays. Assets at risk are labor-intensive, over-reliant on domestic demand, or stuck with outdated small room configurations. Success is no longer a given. It must be engineered. Before we conclude, here is your investment checklist for this new qualitative market. Before signing any deal, ask these 3 questions. Can this asset thrive with fewer staff? Is it positioned for the next wave of spillover demand? And does the hardware match the expectations of the modern international guests? Thank you for your time, and if you found this video helpful, please like and subscribe. See you soon. Bye bye.